Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
It is remarkably nice out here today. You know, getting out of the office and actually walking while we talk through this material makes a huge difference.
Oh, it completely clears the head.
Because today, we are tackling something that sits right at the heart of financial intermediation theory. We are asking, the oldest question in the book. What actually makes a bank special?
It's the fundamental question, isn't it? And, if you go back to the basics, to Modigliani-Miller, the frictionless null hypothesis is that a bank's structure shouldn't matter at all.
Right.
In a perfect market, a bank is just a veil. It takes money from A and gives it to B. Its market-to-book ratio should be 1. Exactly 1.
The irrelevance theorem. But of course, we look at the data and we see market-to-book ratios all over the place. Some are 0.8, some are 2.5. So clearly, they're creating value somewhere.
Right.
The tension has always been, is that value coming from the asset side screening borrowers, monitoring loans, the whole Douglas Diamond view?
Mm-hmm.
Or is it the liability side creating safe, liquid money, more of a Gorton and Pinacki story?
Exactly. Is a bank a store of value, or is it a creator of credit? And usually these are treated as, separate theoretical silos.
Right.
But the paper we're diving into today, the cross-section of bank value by Egan, Lewellen, and Sunderam, it does something really ambitious. They don't just theorize, they build a structural econometric framework to measure both sides at the same time.
They create a horse race.
They create a horse race between the lending desk and the deposit counter.
And the result they find is pretty provocative. For years, the glamorous side of banking has been the asset side, right? The loan officers, the deal makers.
Oh, yeah, the masters of the universe.
But these authors argue that for the median U.S. bank, 2/3 of value creation is actually coming from the liability side, from what they call deposit productivity.
It just flips the conventional wisdom on its head. It suggests that the boring old business of taking deposits is actually the primary engine of shareholder value.
But to really buy into that conclusion, we have to unpack how they got there. Because separating these two things empirically is, it's incredibly difficult.
Oh, they're completely tangled up. Same balance sheet, same management, often cross-subsidized.
So let's break down the machinery. This isn't just a simple regression of profit on deposits. They are using tools from industrial organizations, specifically structural estimation.
Right.
They modeled the bank as having two distinct divisions under one roof. Let's start with the liability side. How do they even define deposit productivity?
So they treat deposits as a differentiated product. Think of it like selling cars or smartphones. They use a discrete choice model, a BLP-style framework.
Okay.
In this model, consumers choose a bank based on the interest rate, the service quality, branch density, all that stuff.
Okay, so in that context, productivity isn't about how fast a teller counts cash. It's not an efficiency metric in that sense.
No, not at all. In this IO framework, deposit productivity, which they call delta, is essentially a demand shifter.
A demand shifter?
Yeah. Imagine two banks, Bank A and Bank B. They both offer the exact same interest rate, same number of branches, same number of employees. But Bank A manages to attract $10 billion in deposits, and Bank B only gets $5 billion.
Then Bank A has higher deposit productivity.
Precisely. It represents the intangible value of the franchise. It captures brand trust, marketing, convenience, maybe the perception of safety. It's the brand premium of the liability side.
Got it. Okay, now flip it. The asset side. How are they measuring asset productivity? That feels like it should be harder to pin down, given how opaque loan books are.
Yeah, for this, they move from a demand model to a production function model. They treat the asset side like a factory that takes in funds and transforms them into revenue. They use a Cobb-Douglas production function.
And the output is risk-adjusted revenue.
Exactly, interest income net of losses. The input is just the asset base.
So, similar logic. If Bank A and Bank B both have $10 billion in assets, but Bank A generates more risk-adjusted income from that,
then Bank A has higher asset productivity, or PHI. It implies they're better at screening borrowers, better at pricing risk, or maybe they just have access to a better lending market. It's the skill component of lending.
Okay, so we have these two primitive measures.
Yeah.
Delta for deposits and phi for assets. The challenge, and I know this is a big focus for our listeners, is identification. You can't just regress market share on prices because prices are endogenous. It's the classic simultaneity problem.
Right. If a bank creates a great new mobile app, that's a positive demand shock. They might then decide to lower their deposit rates because they don't need to pay as much.
And if you just run the regression, you'd conclude that lower rates attract more customers.
Which is nonsense, yeah. Your elasticity estimates would be completely biased. You need instruments. You need some kind of exogenous variation.
So let's get into their IV strategy. For deposits, they use the pass-through of LIBOR. Walk us through that logic.
This part is clever. They look at how sensitive a specific bank's deposit rates are to the 3-month LIBOR. We know from other work that these deposit betas vary a lot across banks.
Right, because of market power or stickiness.
Exactly. And that pass-through is a supply-side characteristic. It's driven by the bank's strategy, not by today's consumer demand shock. So they use that to instrument for rates.
Because the LIBOR rate is exogenous to whether my local bank's app crashed this morning. The global market doesn't care.
Exactly. It isolates the variation in rates that's driven by macro factors, not local demand, and lets them estimate the demand curve cleanly.
And for the asset side, they need an instrument for bank size, right? Because a bank that's good at lending is just going to grow bigger.
Correct. If you're good at lending, you expand. So to break that, they use the weighted average deposit productivity of the bank's competitors.
Competitor productivity. That sounds counterintuitive at first.
Think about it as a cost shifter. If I'm Bank A and my competitor, Bank B, suddenly gets really good at raising cheap deposits, their delta goes up, that puts pressure on me.
Ah, I see. It might constrain my ability to grow because I'm losing funding share. So it affects my size.
But Bank B's deposit productivity has nothing to do with my skill at picking loans.
Right.
It affects my size, but it's orthogonal to my asset productivity. It satisfies the exclusion restriction.
That is a very clean exclusion restriction. Classic stuff.
Yeah.
Okay, so they run this huge structural estimation. They recover these deltas and fifths for every bank quarter for like 20 years.
Yep.
Then they take these productivity measures and regress the bank's market-to-book ratio on them. What is the headline result?
The headline is the complete dominance of the liability side. When they look at the cross-sectional variation in market-to-book, deposit productivity explains about 66% of that variation for the median bank.
Two-thirds.
Two-thirds. Asset productivity explains roughly 33% or even less.
That is a stark split.
It is. A 1 standard deviation increase in deposit productivity raises the market-to-book ratio by anywhere from 0.2 to 0.8 points. That is a massive driver of value. Asset productivity has a positive effect, for sure, but the magnitude is just so much smaller.
Wow. This really reinforces that banks are special because of safe assets theory. But they dig even deeper. They break it down by the type of deposit. And this is where it gets really interesting. It's not checking accounts that drive this, is it?
No, and that was surprising to me at first. You'd think transaction deposits checking accounts would be the sticky, high-value funding.
Yeah, inertia.
Right. But the authors find that savings deposits are the primary driver of value.
Why savings specifically?
It seems to come down to that trade-off between safety and liquidity. Transaction deposits provide liquidity services. Savings deposits are all about safety, and their estimates show that the demand for savings deposits is highly inelastic.
So the premium is on safety. The bank is essentially an insurer that manufactures safety.
That's the killer app. It creates more shareholder value than providing payment rails.
And on the asset side, what do they find there?
There, they find asset productivity is most correlated with holding real estate loans and offering loan commitments.
Which brings us right back to Diamond. That supports the monitoring story.
It does. Real estate and credit lines are information intensive. You have to screen, you have to monitor. So the authors aren't saying the asset side is irrelevant.
They're just saying it matters less.
Exactly. They're saying, yes, screening matters. Yes, monitoring creates value. But the magnitude of that value creation is just dwarfed by the franchise value of the deposit base.
Okay, I want to play devil's advocate here, and I'm sure some of our listeners are thinking this too. Can we really separate them? I mean, I'm thinking of Kashyap, Rajan, and Stein.
The synergy argument.
Yeah, the synergy argument. Banks exist to bundle these two things. I take in deposits so that I can offer lines of credit. If I have high deposit productivity, doesn't that just make me a better lender?
That is the key challenge. And the data bears it out to an extent. The correlation between their measured asset and deposit productivity is about 0.45. They are linked.
So how do they prove it's not all just synergy?
They do this really smart residualization or bounding exercise. They basically say, okay, let's take the worst case scenario for our argument. They attribute all of the shared variation, that entire 0.45 correlation, to the asset side.
So they strip out anything from the deposit measure that could possibly be related to lending skill.
Everything.
Yeah.
And Even then, the residual, the pure deposit productivity still explains the majority of the variation in market to book. The result is just incredibly robust.
That's a very strong robustness check. It suggests the deposit franchise has value completely independent of what you do with the money.
It does. It implies that if you could just be a deposit-taking firm that invested only in treasuries, a narrow bank, you would still capture a huge chunk of the value that current banks have.
So what drives that productivity? Is it just demographics? If I'm a bank in a wealthy suburb, am I automatically a high productivity bank?
Geography is part of it for sure. They find population and wealth explain about 40% of the variation. So yeah, being in the right place matters. But that leaves 60% unexplained.
So what's the rest?
It seems to be technology, but defined very broadly, not just IT. They link high deposit productivity to lower rates of consumer complaints using CFPB data.
So customer service.
Service, trust, operational competence. They also find that high productivity banks use more sophisticated pricing. They don't just set generic rates, they decentralize it, they price discriminate more effectively. It's managerial skill.
That's fascinating. So it's not just we have a branch here, it's we treat our customers well and we know exactly how much of a rate we can get away with.
Which is an operational capability. It's an intangible asset. And because it relies on trust and brand, it is highly persistent. The autocorrelation of their productivity measure is something like 0.99. It's incredibly sticky.
This has huge implications for M&A. If I'm a CEO looking to acquire a bank, this paper says I should be looking at their liability stack, not their loan book.
Absolutely. If you buy a bank with high asset productivity, you're buying a team of good lenders. People leave, credit cycles turn. But if you buy a bank with high deposit productivity, you are acquiring a sticky, inelastic funding base. That is a much more durable competitive advantage.
It also reframes the whole discussion on charter value.
Right. And this quantifies it. It says the charter value isn't just the license to lend. It's the license to issue safe liabilities. For policymakers, this is crucial. If a bank's value is derived so heavily from this deposit franchise, then ensuring the stability of that franchise is paramount.
I want to pivot to a thought that struck me while reading this. Fintech. We see so much activity in fintech right now, but a lot of it is focused on the asset side.
Yeah.
Algorithmic lending, peer-to-peer, buy now, pay later. If this paper is right, aren't those disruptors just fighting for the crumbs?
That is the big strategic implication here. If 66% of the value is in manufacturing safe liabilities, then a fintech that focuses only on better lending algorithms is attacking the smaller profit pool.
And the pool, with lower barriers to entry. It's hard to replicate a sticky deposit base. It's much easier to copy an algorithm.
We see this with the neobanks, right? They struggle to become the primary bank account. They get the coffee money, but the paycheck, the savings, that stays with the legacy bank that has that perceived safety.
Trust is the ultimate currency.
Exactly. And remember the finding about savings versus transaction deposits? Neobanks often compete on transaction features, cool app, early direct deposit. But the paper says the real value is in the savings vehicle, the store of value.
So I have to ask about the interest rate environment. The sample period ends in 2015. We've been in a different world recently.
That's a fair point. The sample covers a lot: high rates, the crisis, the zero lower bound. But you could ask, in a world where T-bills are yielding 5%, does the deposit productivity of a bank erode?
That's the deposit beta conversation we're all having right now. If customers finally wake up and move their money, that delta, that demand shifter, just drops.
It does. And if that shifts, the bank's value should collapse, according to this model. And that's exactly what we saw with some of the regional bank failures. Their ability to hold funds at low rates, their delta, it just evaporated.
So it actually validates their approach. When delta crashes, the market-to-book crashes.
Precisely. It recenters the bank as a liability-centric entity. The asset side is just what you do with the money, but the business is the money.
Okay, so let's wrap this up. We have a paper that uses rigorous structural I/O to separate the Siamese twins of banking. It finds the boring business of taking savings deposits creates twice as much value as the exciting business of lending.
And that this value is driven by an intangible productivity, a mix of brand, service, and safety that is highly persistent.
It's a compelling argument to look at the liability side of the balance sheet with a lot more respect.
And perhaps a lot more scrutiny.
Before we sign off, here's a thought to chew on. The paper establishes that banks create value by manufacturing safe assets. But what happens when the definition of safe changes? We are moving into a world of central bank digital currencies, of CBDCs and stablecoins. If the government starts offering a direct, safe asset to consumers. Does that just vaporize the 66% of bank value that comes from deposit productivity?
That is the existential question. If the Fed offers a digital wallet, the safety premium that banks enjoy might go to zero. They'd be forced to survive on asset productivity alone. And as we learned today, that's a much, much tougher business.
A sobering thought for the walk back to the office.
Indeed.
Thanks for joining us on this deep dive. And for those of you who really want to geek out, I highly recommend looking at the appendix of that Egan, Lewellen, and Sunderam paper. The detail in the IV specifications is a masterclass.
It really is worth the read.
Until next time, keep diving deep.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.